Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the family trust. Now, the family trust has a fair bit of overlap with some other sections that we're concerned with. It's concerned with attribution, so you might find it useful to go back and watch videos on attribution. There's some relevance here for capital gains. And then, of course, there are the basic trust videos, the taxation of trust and trust structure videos. And you'll find this video is not something that's necessary at the basic levels. This is something that's more useful if you're going through a financial planning or estate planning course. So as I said, it might be useful to review the taxation and the basic trust structure videos. There's also some overlap here with some more complicated concepts like the lifetime capital gains exemption and tax rollovers. You'll see this as we get into it. This is actually quite a complicated area. So generally, what the family trust is designed for, as with most other trusts, we're going to review the concept here. As I like to say, a trust means no trust. That is, I can accomplish everything that I want to accomplish outside of a family trust, but I want to use the trust here specifically because I have people who are going to be owners, so people who are going to own this property, but I have some concerns about their ownership. And those concerns might relate to a few different circumstances. I might have concerns because maybe those people are irresponsible. I might be concerned about a future divorce. One of those people might be married to somebody where I think if they get divorced, then there could be some fight over this asset, and we're going to keep it out of the divorce now. I might have concerns where maybe just one of them is not going to be good with money, what we often call a spendthrift. Oops, a spendthrift. So numerous possible concerns here. Now, it's not a trust issue so much. Another issue that can arise here is if we have minors involved. We may want minors to own shares, and minors are generally legally prohibited from owning shares in businesses. Oops. And other concerns here, we might have a corporation that's under the Prof Corp or the professional corporation rules, and under the professional corporation rules, we are sometimes limited as to who can own shares. For example, in some jurisdictions, a medical practice can only be owned by a medical doctor. We might want their spouse to own shares, but the spouse wouldn't, maybe the spouse is not a medical doctor themselves and wouldn't be able to own shares directly, but possibly, and this is not universally true, possibly through a trust ownership might become possible. And on that note, I want to remind you that this is general information only, and that if you're actually looking to execute the creation of a family trust, that what you really have to do here is go and get competent legal and tax advice. This is not an off-the-shelf type of solution. This is something where every situation is a little bit different, and everybody needs to make sure that the trust they're establishing would meet their particular personal circumstances. So, the first thing we're going to have here is a settlor. The settlor of the trust is normally going to be a third party. And the reason we're going to use a third party is because that helps us get around the attribution rules. Now, there is a possible trigger here later on for attribution rules, so we have to be real cautious around this. But by using a third party, that is typically a family lawyer, accountant, some other advisor like that, to settle the trust, we have a less likelihood that the attribution rules get triggered here. Okay, so we might use the lawyer or the accountant, for example. And now, what we're going to do is we're going to have this person settle this trust with some very basic property, something like a $20 bill or a gold coin or something like that. So a common way to do this is to write the trust document, staple a $20 bill to it, and then put the whole thing into a safety deposit box together. So that would mean the trust has been settled using that $20 bill. And that also means no disposition of assets. The $20 bill is not something that's going to create any capital gains or attribution or anything like that. And now we create the trust. So we have the trust itself here. And so the beneficiaries of this trust, and this is one of these areas where this gets quite complicated. Generally, what we want to do is we want to name as many beneficiaries of this trust as possible, as many people as we can reach out to. So generally, we want to name the business owners, business owner and their spouse. We might want to name kids and grandkids, and that could include minors depending on the particular rules that are in place, even great-grandkids possibly. And it's generally not a bad idea to bring their spouses in as well. So basically make this as broad as we possibly can. And the reason for that, and it's not the only way, again, caution here that there are numerous considerations here. We're going to have our trustee or trustees, and this is probably the most important thing here. These trustees, as you would expect, have to be people who are trustworthy, and there have to be arrangements here whereby we're going to have alternate or contingent trustees. We have to know what's going to happen if something happens to our original trustees. We may want to put some safeguards in here so that one trustee can't exercise undue influence, or maybe we don't want the trustees to strike a deal with one of the beneficiaries to do something inappropriate to favor one of the beneficiaries. We may have the trustees post a bond. So we may ask them to post a bond so that there's some security there if they do something inappropriate with that trust. All kinds of things that we can look at here. You might have a board, you might have one single trustee. It might be that the original business owner is the trustee. We might have the original business owner act as trustee up to a certain limit, where if they're going to sell the business, for example, they require the consent of other trustees, but only in that event. So lots of possible considerations there. Now, in most family trusts, this trustee is going to have what we refer to as absolute discretion. And that absolute discretion means that that person exercises control as to when property flows back to those beneficiaries. Now, you have to be careful here, because depending on the property that the trust owns, you can have an attribution problem if you have a settlor and beneficiary who's also a trustee, or even in some cases where we have a beneficiary who's also a trustee. So you have to make sure that you respect the attribution rules, and this is where you have to look at the specific kind of property that's going to be held in the trust, and this is where we need that good, competent tax and legal advice. So then we're going to have whatever property is held in the trust. But you'll remember here, hopefully, that the only property we have in the trust is that $20 bill. Well, this trust is pretty useless right now. So what we want to do is, and this is generally the easiest way to do this, and the way that's least likely to involve any sort of attribution concerns or any sort of violations of corporate law, is to have our trustee go out and borrow some money. So this trustee goes out and borrows funds and uses that borrowed money. And we have to be careful here that they're doing this in their capacity as trustee. They're not doing this as their own selves. They're doing this as the trustee for those beneficiaries. So this trustee will go out and borrow some funds and then use those borrowed funds to purchase property such as shares in the family business at fair market value. And as long as we purchase that property at fair market value, then we generally probably don't have any attribution concerns. And now what we can do here, so let's say that the property happens to be shares, and those shares pay out a dividend from time to time, so that now we can take that dividend and we can distribute it to our various beneficiaries without any sort of concerns. The beneficiaries would pay the tax on those dividends, and now we have created the family trust. We're sprinkling those dividends amongst those beneficiaries, which is why we sometimes refer here to a sprinkling trust. Now, I've shown you one example of where the family trust is useful. It's certainly not the only, or where the family trust, how the family trust gets implemented, sorry. It's certainly not the only example. There's lots of other possibilities here. A couple of other considerations is that we are going to have the 21-year rule here, which you'll recall says that every 21 years, the property of this trust is deemed disposed and we're going to have our full capital gain. So generally what we want to do is at some time prior to 21 years, prior to that 21st year, we want to have some sort of a distribution of that property. And this is another place where the family trust actually becomes quite useful, because what we do now is we, let's say at the 20th year, we distribute the property to the beneficiaries. We settle the property to beneficiaries, who hopefully we now have an idea who we can trust and can't trust. And then we get those beneficiaries to use their lifetime capital gains exemption. And now we would have as many lifetime capital gains exemptions available potentially as beneficiaries available. So we multiply the lifetime capital gains exemption, and we're less concerned about that disposition of the trust property. Now that assumes that the lifetime capital gains exemption applies. That assumes that we actually have the ability to use that lifetime capital gains exemption. But if that's the case, then we're in good shape. So again, this is just a brief overview, a 12-minute overview of a very, very complicated area of estate planning, but an area that gets a lot of attention. It's often recommended as a sort of long-term estate planning solution, and it can be very useful. But really, we have to recognize also that the limitations here are essentially that all we're doing is creating multiple beneficiaries who can then enjoy the dividends paid by this business or enjoy some other distribution of income generated by whatever property the trust holds. And we can have those beneficiaries enjoy that income without the risk of, let's say, a divorce coming between the ownership of the, or without the risk of, say, a divorce wrecking the ownership of, let's say, the family business. So you have to be a little cautious with this, but it can be quite useful. I hope you've found this helpful. You'll find that this fits into the much larger estate planning discussions we've had around trusts, around attribution rules, around corporations and holding corporations to some extent as well. So thank you very kindly, and I hope you enjoy your continued